Hey guys, welcome to Stock Talk. I'm really excited about today's video. Do you want to learn how to turn a dollar into 10? Well, you don't need to play the lottery to do it. Today, we're going to talk about how that's possible by trading the S&P 500. We're going to be talking more about theory than about any one particular stock. In this video, we're going to talk about what a market index is, how it's different from a stock exchange, and why so many economists and finance researchers use the S&P 500. We see that most of you are not subscribed yet. Subscribe, since it helps with the YouTube algorithm. You can always unsub later. Also, favor yourself by hitting the bell to get reminded when we have a new video. Now let's get into it. So, you've decided to turn a dollar into 10. Well, before we dive into why the S&P is such a good investment, we have to completely understand what it is. Hit the like button to understand better. Make sure it's blue. The S&P 500 is a stock market index containing 500 large companies listed across many different stock exchanges. Contrary to popular belief, the S&P 500 isn't just a list of the 500 largest companies whatever they are. They actually handpick 500 large companies, not necessarily the biggest ones, according to various metrics. So, what's the difference between a stock market index and a stock exchange? Well, a stock market index, like the S&P 500, is just a list of stocks. It isn't actually a place you can buy and sell anything. A stock exchange, on the other hand, like the New York Stock Exchange, the London Stock Exchange, the Nasdaq, etc., are actual secondary markets where people can buy and sell stocks. Remember those old videos of stockbrokers in suits yelling buy or sell, sell, sell at each other while holding up pieces of paper? Those brokers were actually in a stock exchange, typically the New York Stock Exchange in those videos. Because a stock exchange is literally the market you go to buy or sell stocks. The S&P 500 isn't a place you can buy or sell stocks, it's just a list. So, how do they determine which stocks are good enough for the S&P and which aren't? There's actually an official list of requirements a stock must meet in order to be listed in the S&P. In order to qualify, a company must have a market cap of at least $8.2 billion. It must be headquartered in the United States, it must have the value of its market cap trade annually, have at least 250,000 shares trade in each of the previous 6 months, most of its shares must belong to the public, as opposed to financial institutions. It has to have been at least a year since the company's IPO, so at least a year since the company went public, and the sum of the company's previous 4 quarters of earnings must be positive, as well as the most recent quarter. The fact that the S&P 500 is so selective about which companies it lists, while still finding 500 companies that make the cut, is part of the reason economists and finance researchers use the S&P 500 as a de facto measure of the market. If you hear someone say the market dropped 900 points today, they're usually referring specifically to the S&P 500. Many mistakenly think that the S&P's role as the market came about because of how big the S&P is. It's 500 companies after all, while the other biggest indicator of the market, the Dow Jones Industrial Average, is only 30. Well, this isn't entirely true. The S&P 500 is huge, yes, but it's actually not the biggest stock index out there. That honor belongs in the United States to the Wilshire 5000, which, as its name suggests, contains, you guessed it, 3,500 stocks. There are actually quite a few stock indexes larger than the S&P 500. For example, the Russell 3000, the Russell 1000, or even S&P's very own Global 1200 index. So why is the S&P 500 considered to be equivalent to the US stock market as a whole and these other indexes aren't? Well, first of all, it only consists of American companies. Second of all, it carefully selects which companies it includes. And finally, most importantly, the current price of the S&P 500 isn't just a sum of all the stock prices it contains at any given moment. The S&P 500, rather, uses something called the float-adjusted market capitalization of each company, rather than its stock price in its calculation of how the market is performing. By float-adjusted, we just mean that the S&P 500 only counts shares of each company available to normal retail investors, not financial institutions, governments, or the company's management. In this way, the S&P 500 truly is a much more accurate representation of how the stock market is doing for ordinary people invested in it, rather than something like the Dow Jones, which just literally adds up the stock prices of all the companies listed to come up with its final valuation. Additionally, the fact that the S&P 500 only includes companies with a majority of their floats in the hands of the public helps its credibility, as there are many companies out there with massive swaths of their shares held only in-house by management or employees, and therefore to include those companies, no matter how big they are, in a measure of the overall stock market would be somewhat erroneous. Now, compare this approach taken by the S&P 500 with that taken by the Dow. The Dow is certainly a great measure of the market and is a very useful tool for investors, but when they don't add any weights to the stock price data they get from the companies they include, you end up with a situation similar to the one we have right now, where just a few mega large cap companies, such as Amazon and Apple, just have to have a relatively good day to make it look like the entire market is moving up. So, is the S&P 500 a good investment? Well, first of all, you can't actually invest in the S&P 500 straight up. Rather, there's an index fund called the SPY that tracks the S&P 500, and that's what you should invest in. But in general, yes. The SPY is generally seen as a slow-moving, safe, and ultimately profitable investment. In fact, if you had invested $1 in the SPY 30 years ago, you'd have $10 today. However, it will probably do the next 30 years as well. But why is the SPY a good investment if it moves so slowly compared to individual stocks? Typically, there are two types of investors: those who believe in an efficient market and those who believe in an inefficient market. Those who believe in an inefficient market think that it's possible to outsmart or beat the market by choosing select stocks based on either financial data or information about the company itself. Hedge funds, for example, believe in an inefficient market. Their goal is always to use riskier investments to beat the market. There is a lot of research out there on the hedge funds and an efficient market, and the general consensus is that while it is possible to beat the market over the short term, if you have the same level of knowledge about individual stocks as everybody else, for example, you aren't an insider, over the long term, those who believe in an efficient market, that is one that can't be beaten, might actually be correct. If someone invested in the S&P 500 in the greatest depths of the Great Recession, they would have nearly quintupled their money by now. That's fairly solid returns, but of course, there are times when the market moves down as well. So what affects how the market moves? Obviously, a lot of things impact movements in the market. Political uncertainty, expectations about inflation, even the general mood of the country can deeply impact whether the market as a whole rises or falls. But the biggest key that most investors overlook: the interest rate. When the Federal Reserve raises or lowers interest rates, this causes massive long-term trends in the S&P 500. Why is that? Well, there are generally two main classes of securities that an investor can buy: equity securities and debt securities. Equity securities include stocks and things like it, such as options, mutual market shares, etc. Debt securities include anything that is based, as the name suggests, on debt. The most common debt security you can buy is a bond. And the way investors make money while holding onto bonds is through interest payments. In other words, as the interest rate rises, bonds become more attractive, and as it falls, they become less attractive to investors, because the most popular equity security is a company's common stock. Because the most popular equity security is a company's common stock, when rates fall and bonds become less attractive, investors will tend to flee the bond market and flock towards stocks. When rates rise, the opposite happens. That's why it's really important to pay attention to any announcements by the Federal Reserve regarding interest rates, even if it doesn't sound like a very fascinating thing to pay close attention to at first. Since the end of the Great Recession, rates have been held steadily at all-time lows. This is on purpose, to generate interest in buying stocks, and it's worked. The S&P 500 is a great investment, and will continue to be one as long as we continue to exist in this low-interest rate economic environment. So guys, that was a brief economics lesson on stock market indexes, stock exchanges, the seesaw effect between stocks and bonds, and how the interest rate plays into all of that. And finally, my personal thoughts on SPY and the S&P 500. But what do you guys think? Is the market beatable? If so, over how long of a time frame? Is SPY a bull or a bear? Let me know what you think in the comments down below. If you like what you saw, remember to smash that like button and subscribe and turn on notifications so you don't miss more videos. And I'll see you all in the next video.